Yeah, I mean, there's this kind of like fallacy of investing. It's like, let's pick the best stocks and go for the best growth, and we're always going to win. And truthfully, what we want to do is we want to understand what our plan is and invest according to that plan.
All right, everybody, thank you so much for tuning in to our first ever edition of Talking Retirement. And I don't think we could have gotten a better guest for our first episode. There's a huge difference between planning your financials before you're retired versus while you're retired. And this new company, Retirable, we are talking to today, is entering that space and changing the way the financial planning industry is structured and how they do business. So I cannot wait for you guys to meet our first guest ever on Talking Retirement, Nick Mancuso. Thanks so much for coming in today, Nick. How you doing?
Thanks for having me, Ken. I'm doing well. Excited to be here.
Awesome, my friend. So the first thing I want to talk about real quick, and I think this is a segue for what you guys do, is what is the difference in financial planning leading up to your retirement versus during the retirement itself?
Yeah, so to start, I work with Retirable. We're a fiduciary financial advisory service, and we really specialize in retirement planning. Sometimes we like to call it decumulation planning, which is ultimately what the difference is. And as fiduciaries, we only do what's in your best interest. We want to make sure that any recommendations that we make are what's going to be most beneficial for you. So by starting with a financial plan, we really can gear up what's going to happen, what we can predict is going to happen, and how we should invest accordingly. Now, you have like three main phases in your life. You have your accumulation phase. This is when we're working, we're stocking money away for retirement, we're saving up those things. And then we have this transitional period, and we'll see that between like 50, 55, upwards to 67 when you're about to retire. And this is where we're starting to shift gears here and start to plan. Your 401k might start to get a little bit more conservative. We might be looking at certain insurances to protect ourselves. And even like contributions that you make, you have that step up period where you can actually catch up and contribute a little bit more. But then you have this retirement phase, or what we call the distribution phase. And this is when we start to actually take money out of our investment vehicles and spend it. So we're spending down. Really what happens here is investing changes significantly. Whereas before we were putting things away, we want growth, we want growth, we want growth. And when you approach this decumulation side, it's really important to understand what your time horizons are, because that really facilitates how much risk I actually take with my money. And most people have three main buckets that fit that time horizon. We have the money that we're pulling in the next year. That's the income that I do not want to fluctuate. We have the money that we're going to be pulling in the next 10 years. That needs to be stable. I don't want to take too much risk here. And then we have to keep up with things like inflation. So we need growth for anything that we're not going to pull in those 10 years. And how do we actually build a plan to assess what those cash flows look like, do it tax efficiently, and then say, how do we actually invest from here out?
So it's a very different skill set from when you're young. We're both in our 30s and you're looking to accumulate as much wealth as you said and be a little more aggressive and a little more, tolerant of risk versus what you guys primarily do, which is you say, this is how much money you have. Let's make this last 20 or 30 years at a lifestyle you feel comfortable at, correct?
Yeah, it's not just making sure it's last. It's understanding what is safe to spend. What are the goals that we have so that we can kind of mitigate these kind of lumps in taxes that we can also have coming through. Let's say we want to take a $20,000 trip one year. What does that do to our tax bracket? And then achieving any other goals that we have, such as legacy as well. But at the core, we want to understand what is safe to spend and how do we invest appropriately to give you that money. And essentially, we're going to take your investments and we're going to create a paycheck for you out of them, so you can live that comfortably and confidently, without a doubt. I mean, looking somebody who's 30 years old, I'm not taking distributions anytime soon. My time horizon is totally geared for growth right now. But somebody who's 60 years old and is about to retire in 5 years, what do we do with that money in 5 years? How are we rebalancing and reassessing what our investments are at that time?
That's awesome to hear. So what you guys do is you say, let's not make you eat rice and beans all day for the rest of your retired life. Let's have some fun. Let's make sure we build in the things that make life worth living into the plan. It's not just, only spend $1 a day or something and just hold as much money as possible.
Yeah, I mean, we have like three different personality types in retirement, and you have those who significantly overspend. They say, you know what, I've lived my whole life for this. I'm not going to have fun when I'm 85 and 90 years old anyway. Let's do it all now and let's really go for it. But where that can kind of like have its downside is what happens if we have a long-term care issue and things like that. We don't want to be a burden for our families. We have the people who like thread the needle, but it's actually really slim. And a lot of people actually underspend significantly in retirement. They play things way too conservatively. They're not invested for growth and they don't have these different buckets set out. So what they do is they limit themselves in their early years of retirement due to that fear. And we end up spending essentially our golden years really, really tight when we don't need to be. And that's where we can open up the doors. Let's take a look at everything the way that we want to play it. Let's figure out what our goals are and figure out what is safe to accomplish so that we can go into retirement not only like living the life we've worked so hard to achieve up to that point, but having all our goals and not having to have this kind of like ambiguous anxiety about it as well. Um, what I would say is 72% of Americans don't have a financial plan. They might have an investment advisor, a 401k, a brokerage account somewhere, but nobody is sitting down and saying, let's put all of this together for you and see how it all works together, including your housing costs, your debts, any taxes that you owe, especially your healthcare costs. It's one of the major concerns inside of retirement, and that's why we recommend working with uh, a very, very trusted broker. But like these things are essential spends, and then we have our lifestyle. It's how we want to live and what we want to do. How do we bring them all into one place? Take a look at it holistically, and then start investing. And that's why that plan first is super, super important at this stage in your life. It's also the reason why we do that as a free consultation for our clients. That's the first thing that we do before we start talking about investments.
That's awesome. Yeah, I think it's good to have, like you said, a game plan, because anybody can just put money automatically into an IRA or a 401k or something like that. But if you don't really know what your money's doing for you or how you're going to spend it, you could just be accruing money and being scared you're going to lose it. But like you said, you can actually live a better, healthier, more fun retirement if you just have a little bit of guidance that says, hey, you actually have more money than you think. Let's have some fun with it. I mean, an example is my dad growing up would like never go on vacations. He was an ultimate coupon clipper. And once he retired, he's like, I'm going on 7 vacations a year. Like I did it. So like, I think the idea that you've worked so hard to have this life, you might as well enjoy it, I think is a great outlook for finances. This isn't just spreadsheets and 401ks and all that stuff. There's a reason you have all this stuff. There's a reason you work so hard to have, a very happy, healthy retirement. Like, what is the goal you guys try to give your clients?
Yeah, I mean, there's this kind of like fallacy of investing. It's like, let's pick the best stocks and go for the best growth, and we're always going to win. And truthfully, what we want to do is we want to understand what our plan is and invest according to that plan. That's how we win. And by going through your plan, it's not just you might have more and you can live a better life, or you might need to control your spending a little bit. There's variables inside of this. So by building this plan first, essentially, we're building the most important piece of this puzzle, which is the picture on the box. From there, we start moving puzzle pieces around. So um, take a look at when we should elect Social Security. When is actually the appropriate time to retire? Up to that retirement, how much should we actually be putting away, and in what bucket, whether it's taxable, tax deferred, or tax free, if it's like an IRA or a Roth? Um, how do we adjust for taxes when we have required distributions at 72? All of those things factor in, and by moving those pieces around, we're actually able to optimize your income streams in retirement, so that even if in one scenario we might not have enough, if we move a couple of variables, we might be able to make that and free that up for you and give you a little bit more stable income in retirement. So there's a lot of planning first, investment second, but they need to go together without a doubt.
That's awesome, man. I like that you have a very human element to this financial planning. It's not, a bunch of people crunching away at spreadsheets, like I said earlier. So, I've dealt with you before. Our team has. We have obviously seen the amazing stuff you guys do, but what do you think is the primary difference between a company like Retirable and, your average giant investment firm or like a financial planner or something? You guys have been making huge shakeups and making a lot of noise in this space, but what do you think is different between Retirable's mission statement and pretty much the rest of the market that makes you guys stand out and, be so well known and be so well appreciated with your clients?
I think first and foremost, we are true fiduciaries. We don't sell any commission-based products. We are really trying to do what's right for people, and it really comes down to our mission, right? So when you look at a lot of financial planning companies, to get holistic financial planning, everything listed together, what a typically high net worth individual would do for their plans, you need a certain amount of assets for most companies, right? Um, we're talking like $500,000 or more in liquid assets, sometimes a million or more. Otherwise, they're charging you a pretty high fee if you're underneath that threshold, or they're not going to do the detailed planning that you want. They're going to put you into like a model portfolio, and that's going to be that. Where Retirable really comes in is that we have no minimums on account balances. Our fees are incredibly low, so we only charge 3/4 of a percent, so 0.75 annually based off of what we manage, and then we cap that at the first 500,000, so there's no fees on anything above. That way, the cost for you is proportionate to how much we're investing in what we're doing, but the planning always comes in first. Um, I think secondarily, we have dedicated advisors. So the relationship that we have with our clients is not a number where you call a hotline and you get a different advisor every single time. We create long-standing relationships, and that's the probably the best part of my job. I'm going to be honest with you, is helping people to retire and walking them through this step by step, and then seeing them achieve their goals. But that really allows us to know your story and to build this customized for you. And then I would say the last piece. And probably the most crucial here is when we do this, we're thinking about what your goals are in mind. We want to make sure that whatever you want to accomplish, we're here to make it happen. So you're not, again, you're not calling into a call center to speak to a random person. We know your story. We're fiduciary advisors. We're going to do the right thing by you, and we're going to do it at a price point that's accessible to every American. So that 72% that we talked about before, we're trying to bring that to zero, and that's our mission.
That's awesome, man. Yeah. Two things that you said that really resonated with me are, having an advisor stick with somebody for the long term. It's what we do as well with our insurance relationships. But I can't tell you how many times I've had people come in and they ask me about life insurance, and I won't name names in terms of the companies that do this, but they buy a life insurance policy, they buy an investment thing, and they find out 10 years later the person that sold it is gone, and they're just calling into a call center, and it's literally some nameless person that's probably going to get laid off in 6 months anyway. So like, they don't really care. It's so much more rewarding when you can follow someone for years and see their story, and you get to learn from these people and get these really cool life stories along the way. I had a lady come in during annual enrollment this past year, and we're talking, and she was in her 90s, and she said, my husband actually helped storm Normandy. And I went, what? And, it's those crazy stories, like, and that's just an extreme example, but there's so much in between. It's so satisfying to meet people and help them out and have this like holistic, great relationship with them. And I think that's why you guys resonate with your clients so much, is like you said, you're caring for them. They're like a member of your family, and it works out pretty well.
Yeah, I gotta say it is really enjoyable to see people kind of come in and have this anxiety of what do I do? What's the next step? And there's a lot of anxiety with this transition, right? It's a big life move. When have you ever not had that income coming in? And to walk them through and to see them like settle in and get comfortable and understand how everything is going to work, it's just really fulfilling, and that's probably the best part of my job. And honestly, one of the reasons why, as Retirable, like our name says, this is where we focus. We're not that working with you when you're 30 years old. We are specialists in what we do, and we specialize in getting people through the transition phase and through retirement. So we work with pretty much the senior market exclusively, because that's where this type of planning and this approach really, really is the most impactful.
Yeah, great points. And I think that's a pretty good segue into one of my next questions, which, I think you talked in a couple different bullet points, but if you were to give, like a quick stump speech, concise summary, what are some of the primary differences between planning your investments and doing all this financial planning when you're a little bit younger versus when you are about to retire? I know you talked about being more conservative and distributions, but what are some like key bullet points that change when you become of retirement age?
Right. I mean, I think the cliches are all true, right? Buy low, sell high, diversify. Like those are things that are not going anywhere. So whether you're 25 years old and just starting out, or whether you're 65 years old and then you're investing, We want those things. What really changes, the big bullet point, is time to distribution. It's the market is going to move. It's going to go up and down. There's nothing we can do about that. How do I limit that volatility from when I need to capitalize on that volatility? So, like I said before, if you have less than a 1 year time horizon to use those funds, they should be invested in something that is not at risk, right? We're talking cash. We're talking something like a high interest savings account or something along those lines. 2 to 10 years, I want to think about, bonds, things that are yielding dividends, things that are not going to fluctuate with the market more. And anything with 10-year horizon, that's when we're really starting to explore equities and things of that nature. If you're 25 years old, you're pretty much in equities, right? When you look at like the overall market, let's take the S&P 500 um, as that index, for example, and you look at it, yes, it goes up, and there's times of recessions, and like 2008 happens, it drops back down. How long does it take for it to come back and then exceed from that previous peak? It might be 3 to 4 years. In the longest case, it might be 7. But again, if I have that 10-year time horizon, I have time to allow it to recover, meaning that I could stay in the market. I don't have to go to cash and then put it back in and be right twice when I pulled out and then got back in. And that's actually typically how you lose. So how do we design a strategy that's here to weather these recessions? That's here because we know when we're pulling money, I'm not chasing returns, I'm chasing goals. And by chasing the goals that we have, I'm actually able to develop an investment strategy that I don't really care what the market does. We know that we're in the right buckets, that when it comes time to pull that money, that we're going to be in the right place with it, and you're going to succeed in your retirement.
Yeah, that's all great information. I like the confidence that you guys have in terms of saying, doesn't matter what happens with the market, we're going to set you up and make you feel good. And I've seen you on calls, so I know what you do and what you say. But let's just say hypothetically, I am a 65-year-old person. I'm walking in, I'm 6 months away from retirement, and I see eggs are expensive and gas is expensive and inflation is going up, and we keep worrying about this recession due to interest rates going up as well. What exactly are you guys doing when we're on the precipice of a potential recession, a potential financial crisis, to make sure that your money, I'm walking into you right now and I say, we're about to be in a down market potentially. What are you going to do with my money that's currently in equities? Because that's what I did starting at 25 to transition. And maybe the next 5 or 10 years, we're going to weather the storm.
Right. And I think it really comes down to like it's a what if. And that what if can go both ways. What if we go into a recession? What if we don't? What if the market decides to, what if we have a soft landing and the economy and all of a sudden things take off? Interest rates start falling really fast. Interest rates start falling or the Fed is reducing them. Inflation starts to come down more rapidly. And if I'm sitting in cash, then I'm not in the right place and I've missed that boat, right? So being in cash can really capitalize on those losses. We want to make sure we have the appropriate amount of cash. We need your emergency savings there, right? Just in case something goes wrong. We need your income distributions there because that's what we're going to be supplementing any kind of Social Security or pension with. But aside from that, anything else that we have in that next 10-year bucket, that stable bucket, that's already weathering this recession. I have 10 years or longer on that equity portion. I'm going to let that go. And along the way, as the market moves, it doesn't drop 20% overnight. It slowly goes up and down. And what we do is we rebalance inside of your holdings to really make sure that we are, if we're getting a decent dividend rate, we'll take those dividends and buy back the stocks that are at a loss, positioning us to climb back. Or if equities are outperforming, we'll take those equities and we'll shift that back to bonds. That way we're making sure that your portfolio stays within the thresholds that we want. And that rebalancing is a really, really important factor that we're doing constantly.
I just asked you about kind of what you guys do to weather the inflation, weather the storm. Obviously, everybody has different needs. As you being a financial expert, a fiduciary, what do you think is the forecast for the next year or two? We're talking right now, February 2023. There's a bunch of different financial events on the horizon. Inflation has been up for about a year or two straight, though the rate of inflation has decreased a little bit. They've been aggressively raising interest rates on the Fed, and hanging over all of this is this potential debt default. I don't know if it's actually going to happen or not, but it's obviously making a lot of news. In your opinion, obviously things can change, but February 2023, what are some things to look out for, and what do you think is going to happen in the next year or so?
Yeah, I think media is a tough thing to weather, especially when we think about money and our finances and investment. It's something, it's a big concern, right? We've worked hard. This is our lifeline. This is our funds. So we definitely don't want bad things to happen. But if you ever look back at any given year, there's always been doomsayers in the media, right? Marketing is always pushing this. Everybody look out. The world is ending here. I can't remember a year that didn't happen, where the news was just happy, right? It doesn't exist. So it doesn't. You
I
really
love
have
that though. It's so funny. Like we all think that, but the second you say it out loud, it's like, oh, duh.
like go back to 2016, everything's going to go to hell. Go back to 2012, the world's ending, the Maya calendar's coming through, the world's going to crash. Y2K was a big thing in 2000. Like, I mean, at any point there is this catastrophic doom that can come up. And in reality, what we have are economic cycles. We have we have recessions, we have troughs, we have growth, we have the peak, and then it starts to go back down, and it moves in these kind of four cycles all the time. So you have expansion and you have recession. It contracts, it expands. In expand in expansion, great, we have a great market, we're running. But every time, at every moment of that market, somebody's predicting the end of that market in the next month, right? So what do we do when we're thinking about high inflation? Is that coming down? Yes. Right? What is the Fed being somewhat effective in their rate hike that they've made to lower that? Yes, they have. Do we think that it's just going to solve immediately and go away? No, we know that in order to do this, this is going to take a year or two to fix. What we do have in the short term is an advantage to earn interest on our cash, right? I mean, Retirable has a cash management card that's currently yielding four current the current rate of return is about 4.25 on cash, right? And then when we talk about, so there's opportunities here. How do we shift to those? Um, when you think about, right, how long is that interest rate going to be high? Are we planning on purchasing a home? What do we do with mortgage rates? Things like that. Maybe we want to move. That's when we can kind of plan and say what years do we want to do things in. But interest rates might stay a little high for the next year or two, right? And that's nothing that Powell isn't saying when he's talking about the Fed. But in terms of
Yeah.
predicting a recession, of whether things might go one way or the other, speculating is how you can get in trouble. Saying I know for sure that this is going to happen, that is dangerous, because if you're wrong, you're really wrong. I don't care about being right or wrong. I care about being insulated by having a proper plan. And that is materially the difference. We're not here to speculate. I'm not here to try and make money on a downturn and all of a sudden turn rich, because that takes a lot of risk, right? And then we're gambling. We don't gamble in retirement. What we do is we develop a plan that is set so that we can weather storms as they come, and they're always going to come. It's not like this is the first time this has happened. It's not going to be the last time it's happened. What do we do consistently as a program to make sure that we're in the right place?
I really like the way you say that because, I think one of the things that we've looked into is obviously we're a Medicare business. A lot of our clients are dependent on Social Security. And I think there's a lot of hype right now about this whole cutting Social Security, cutting Medicare. But every time I've really looked into it, it's been floated around in back rooms, but I doubt it's going to happen at the end of the day. Like, too many people would, get killed by it. So to me, I think it's like, media and politicians in the cycle, they really need this hype, like you mentioned, to keep people engaged, keep people there. Like I feel like, the debt default would in theory happen in June from what I've read, but I feel like they're going to keep it running until like a week before it happens, and then they'll fix it and be like, thank God, it's
I mean,
crazy to me.
the debt ceiling Congress kind of conversation happens on a yearly basis. Like, this happens always. These are
Oh
just
yeah.
constant things. We're in the same cycle. The news is there to get your attention, so they're talking about it, right? Do I think that the U.S. is going to default on all its debt, and all of a sudden the most secure investment that we have, which is the U.S. Treasuries, is going to be defunct? Absolutely not, right? They won't let that happen. Um, the other thing is, like, like we have this conversation, and you mentioned about Social Security running out. They're slashing Social Security, right? Social Security program for those who are in retirement and living on a fixed income, where are they likely, if they were to make a cut to Social Security, where is it likely to be? On the younger generation who has time to develop and change things, or is it going to be on the people who are currently relying on things, right? When you look at like Social Security increases, the cost of living adjustment that happens on everybody who's 62 and above, who's now eligible for Social Security. If you're underneath that, you're not getting that. And why is that? It's because you're actively taking it. You don't have time to save more. You don't have time to adjust and invest with the inflation. So these are the people who need that cost of living adjustment to keep pace with inflation more than anyone, right? If we see changes to Social Security, it's not might not be a slash. It may be some type of adjustment here. Who's it more likely to happen to? Right? And if it happens, right, you have both sides talking about it, and both sides are pushing back. This is a fundamental part of our society at this point, which is Social Security and the income that it provides when you're no longer working. So I don't think it's going to disappear by any means, right? Um, it'll definitely make the news because that's what the news does. Um, again, the last happy story I saw in the news was probably the turtle kid, um, who likes turtles at this county fair. But aside from
Yeah.
that, you're really not hearing great things. It's always doom. It's important to understand what's the difference between the doomsayers over the entire thing and what actually is going on for you individually. And that's why customized individual plans are more important.
Yeah, no, I like the way you say it. 2 points to kind of feed off that are, I see a lot of people like Warren Buffett or these big financial guys are just like, investing should not be sexy. It's really just putting money into like index funds and like bonds, and over time it just increases at a rate higher than inflation, and that's what sets you up. It's not, putting all your money into cryptocurrency or NFTs or whatever the fad of the week is or anything like that. It's really, like you said, having a long-term plan and not getting fluctuated by all this stuff. And kind of going off that same news hype, if you look at some of these personalities like Jim Cramer, like all those people that are like the big financial guys, if you really look at their track record, like their investments are way below the market. Like they're all very bad, and it's just not something you want to focus on because, like you said, it's more about having a long-term plan and vision and not getting caught up in these doomsayers. I think it's a great point to bring in, like bringing
Well,
some stability to the process.
yeah, well, take Jim Cramer for example. Like nothing against Jim Cramer, but he's doing a very different type of investing, right? Because if Jim Cramer was doing the type of investing that we're recommending for our clients, he wouldn't be in entertainment. There'd be nothing going on. It'd be what a boring show. Let's put together this plan. Here's your safe buckets. Here's where we go for growth to compete with inflation. Do this on a consistent basis. That's one episode. It lasts an hour long, and he's not on TV every single day, right? He's talking about day trading. He's talking about moving
Yeah.
things quickly, trying to capitalize on every single situation that's out there. And you're absolutely right. Sometimes he hits, sometimes he doesn't. What actually happens is those two things average out, and you end up underperforming this kind of passive strategy that we could have gone with that was way less stressful in the first place. And you know, you talked about ETFs and these index funds that we like to use. They're great because what do they give us? They give us this massive amount of diversity, this kind of follow along with the market in general. I don't have to sit there and pick individual stocks and do those things. So even if I'm working with a lower amount of assets, say 100, 200,000, I don't need the $1 million to diversify that portfolio properly. I can use these ETFs, these index funds. They're extremely low cost. They get me the diversity I need. They fit really well into this long-term plan, and that's how we like to build portfolios.
Yeah, so quick note, one of my favorite business guys is this dude, Scott Galloway. I've read a couple of his books, but I read an article recently. Someone who was not a fan of his created the anti-Galloway index. And this guy gives investment advice basically for a living. And someone did the opposite of his advice and got like 30% returns or something like that. And it just kind of goes to show you like the craziness out there. But I want to switch back. I appreciate all your insight on current events and all that stuff. And I can see why people are so calmed by you and your team because you just say, don't buy into the hype. Let's figure this out. Something I've noticed when I'm on a call with you talking to, our clients that we send to you is you always talk about having this retirement team per se, and there's a couple different players that you assemble to make sure that you have all the people in your stable basically to make sure that you're set for the long term. Who are some of those key players, and how do you create that holistic retirement team outside of you, the retirement planner, me, the Medicare guy? Who are some other key players that you bring in when you're about to retire?
Yeah, so there's different ways to talk about this. I think I've heard it called center of influence, sphere of influence. I no matter what name you have for it, essentially you want to surround yourself with people who specialize in different things, right? Um, and the most akin that I could do this to is like doctors. You have your GP who does a little tiny bit of everything, but that's who you go to when you have the sniffles, right? Like honestly, something's wrong with your feet, you go to a podiatrist. Something's wrong with your back, you go to a back guy. I don't know what they're called. Something's wrong with your eyes, you go to a eye doctor, an ophthalmologist.
Ophthalmologist,
There
yeah.
we go, we got that one. But you have these specialists, and in your financial world, right, you want the same thing. So who are the specialists in your financial world? You have your planner and your investment advisor. You have your insurance specialist and your healthcare specialist, which is you guys at New Jersey Life and Health.
Hey.
Um, you have sometimes, depending on your situation, you have an accountant. So especially if things are very, very complicated, and you have income sources from like rental income and passive income all over the place, and or maybe you're just big into the casino, and now all of a sudden you have a ton of winnings. You might want to speak to an accountant about like how we're mitigating things. We always recommend that. And then you have your legal side, and that legal side also can be that estate side. So how do we protect our estates? How do we set up things like wills and trusts, power of attorneys, and healthcare proxies? These things are really, really important, and that legal side is going to help to bring that all together. All of these pieces work together, right? So you want to make sure that you are the center and you have that influence around you in that circle. So really, if I have a tax question and I really need somebody to help me prepare it, can I go to my financial advisor and can he kind of give me of how this actually works? Yes, I can give you uh, information on how your taxes work and how everything goes together. But am I preparing taxes for you? Absolutely not. I am a retirement planning specialist and distribution specialist for investment. I don't prepare taxes. That's not my specialty. You need to speak to your tax professional to get that center of influence. They're the one that's staying up to date on what's going on and what's current. So having a different aspect to reach out to, but being the center of all those things can really just make a huge difference in your life of financials, your financial well-being, your health and wealth, your I don't know, what do you want to call it?
Holistic retirement. I don't even, yeah, yeah.
Holistic retirement. Yeah, exactly.
Holistic retirement trademark, we got that. So, I think that's a great way to look at it. And I can't tell you the amount of times I've had clients who did not do the proper estate planning or that kind of thing. And it really can send huge roadblocks throughout the whole process. If you don't have a power of attorney set up, if you don't have an estate set up, even little things like having a master document of all your passwords or something like that to give to your kids in case, you are unable to walk or talk or something like that. I had someone at the end of last year. It was very unfortunate, but basically the mother passed away, and it took her kids about 2 months to finally, I almost want to say, break in to her email to see that she had been in contact with me and that there were things we had to do for other members of the family. So, adding as much planning as you can. It's so much better to just plan a little bit now than deal with all the crap later, because it can just send shockwaves through the whole process as you're going through it.
Yeah, what's the old adage? You don't plan to fail, you fail to plan.
Yep. Wise words.
No, but yeah, I mean, keep having a list of all your passwords somewhere secure. Very, very important. Having a list of all the insurances that you have, whether it's life insurance, long-term care insurance, anything like that, that needs to stay somewhere and somebody needs to know where it is. Ideally, a safe. Please don't put that in the notes section of your computer. That's how you get in trouble. Uh,
Yeah.
but but yeah, like you're saying here, all these things definitely play into each other and make things going well. But we when we speak to our clients, we really kind of talk to them and we understand what their concerns are. And the two most prevalent ones that come up, number one, am I going to have enough to retire? What is safe to spend? What do I do with this investment? But number two is the big concern over healthcare plans and healthcare costs derailing that plan that they've put together. And that's why we love partnering with you guys so much, because um, you truly take the mission that we have and you apply it to the healthcare side, and we love that with your clients as well.
Yeah, yeah. I feel like we're almost like cousins or something like that, like doing the same thing, like same general vibe, just like different industry basically. So it's always good to partner with you guys, and
Yeah,
you
the
know,
vibes are great.
vibes are immaculate. So just want to leave you with like one or two more questions. You know, we talked a lot about the things that you guys do, and there's so many great tidbits of information. What is a mistake that you see people come to you with? You know, maybe they're about to retire, maybe they've been in retirement and they're not super happy with their financial planner. What are some mistakes you see from people in the retirement sphere as in terms of personal finance and all that stuff?
I would say the first one is this overwhelming fear that everything is going to collapse, and we move everything into cash, right? When you look back to like 2008 for a perfect example, you may have stopped the loss, but you never got back in at the right time. So the people who move to cash, they stay in cash too long. The market recovers. You didn't recover with it. You end up actually capitalizing that loss. Working with a planner, helping to understand what we should have an emergency fund first. Like, let's make sure we have the right amount of cash. Having no cash also worse. But like, let's have the right amount of cash and have the right amount of investments. That's the one mistake that I see most often. It's like, let's shift you back into where we need to be and let's get you on this road, right? Um,
It's basically putting all your eggs into one basket in the financial sense. Like that's one way to potentially derail stuff.
yeah. Let's see. Number two is this kind of sunk cost fallacy that we see quite often. So somebody could be in a very, very aggressive portfolio that wasn't right for them in the first place. The market's kind of come down. They've lost a ton. All of a sudden, I don't want to do anything with this. Leave this exactly the way it was. Don't touch it. I need this to come back. Sometimes that protecting that sunk cost can hurt you even more because sometimes depending on the portfolio that you were in, some of those things are not going to come back, right? Some of them may go away. If you weren't diversified properly, if you're in individual stocks and you're holding out for, cruise lines to come back and make a giant resurgence in this year, you might, right? We might want to put you into something that's a little bit more appropriate. So when the market comes back, hey, we're going to recoup that loss, but we're not holding true to something that's now sunk cost because we've lost that we're unwilling to change, right? I'm not saying that we go to cash. I'm not saying that we adjust to something that's too conservative that never returns. I'm saying that when the markets go down, it is a prime time for you to reevaluate and reassess to make sure that you're in the right thing because we can position you in the right place, and somewhat stop the bleeding if it is bleeding, right? Um, that's what's having an appropriate portfolio can do. And then the last mistake, procrastination. That is the big one. The earlier you do things, the more variables that we can pull. I see it quite often with Social Security. Somebody's just like, I'm just going to take it now and figure it out later. Meanwhile, speaking to a financial advisor before you make these one-time decisions only can really make a difference in terms of how much income that you can pull. So before you elect your pension, before you elect your Social Security, you should sit with somebody, put together a plan, find out what the optimal scenario is and what you need to do to accomplish that. And that usually has a ripple effect to everything else that you do, including your investments.
Yeah, it's a great way to look at it. I mean, I can tell you it can be quite sobering when you meet people at retirement. You see the people who procrastinated in terms of putting money into savings accounts and retirement accounts, and the people who had started 30 or 40 years ago versus started 5 or 10 years ago. The difference with the compound interest is, magnitudes bigger than you would think it would be. It's really impressive to see what just a little bit of financial planning, not even anything crazy, just like an IRA or a 401k and a couple small distributions, the difference it can make for you later in life. Because I think what a lot of people don't realize is it doesn't just go into the fun stuff. It can be your quality of life in general. It's what healthcare plans can I afford? What life insurance plans can I afford? Where can I live? Do I have the option to move even, out of the house that I've spent the mortgage on? I think there's so much to it. And if you just look at money as money rather than like a vehicle to do the things you want, not only fun, but to actually live, it becomes a very different conversation. And I think it gives you a little more confidence to actually take this stuff head on as opposed to really, dragging your feet and not worrying about it till it's too late.
Yeah, I'm very glad you said that about the healthcare thing too. I think people oftentimes make decisions regarding their healthcare based off of cost. Um, where that it's a very real thing that influences the healthcare that you can get. But things are different when you're in retirement than when you were 30 years old. You're more likely to use that healthcare significantly, right?
Mm-hmm.
Whereas at 30 years old, unless I fall down the mountain trying to snowboard for the first time in 6 years, like I'm pretty much okay here. But 65, 70 years old, we're definitely getting up there. We're going to be using this healthcare to make sure that we're getting along the lines, and like there are added things that you guys have that we know that clients love, fitness programs and things that really get them to their right network of doctors. And how do we actually say, if you want a certain level of coverage, how do we make sure that that fits in your bucket? What is the impact that that has on everything else? Do we need more withdrawals? What is safe to spend? Again, not just overall, but individually on these individual things that we need, which we would consider essentials.
Yeah, no, I'm glad you brought that in as well. And I actually gave up snowboarding because my friends always want me to do it. But at the end of the day, I know I'm just going to fall down the mountain and hurt myself. So I'll just go tubing or something like that instead, just to make sure.
Yeah, I'm quite accident prone. So I use my healthcare, but
it was pretty funny. My friends actually rented a house in Tahoe this past winter for a whole month, and they were like, "You should come visit." And I went, "Oh yeah, what are you guys doing?" And they go, "Oh, we're snowboarding. You should come." And I was like, "Well, I haven't in like 15 years." And they're like, "Honestly, man, you're just gonna hurt yourself. You shouldn't come." I was like, "All right, thank you for just letting me know about that."
Yeah, my speed's more of the hot tub and maybe a drink, but it's enough of a downhill slope for me.
Yeah, it's much better. All right, Nick. Well, thank you so much for your time. This was so informative, and we'd love to have you again in the future. If someone's looking to talk to you or anybody else at Retirable, where can they find Retirable? And, on top of what we talked about, I guess, where can they find you? And, what are some of your main services you guys offer?
Yeah. So again, we offer free consultations. So come to us. We'll build a plan for you. We'll tell you what we think should happen first, so you don't have to worry about just working with us. We're going to explain exactly what we're going to do for you to go there. But from there, we do investment management as well as financial planning, and then we partner with people like New Jersey Life and Health, obviously, to make sure you have the right insurances in place as well. But I think we have an email address for you guys. Let me pull that up real quick. So the best way to actually reach us, if you're watching this podcast, is to shoot us an email. You could reach us at nj-life@retirable.com. Shoot us your information, and we'll set up some time. And you can also give us a call here directly at 848-222-8062. But honestly, if you're interested in speaking to us, the best thing that you can do is reach out to Ken, Will, or John, or your New Jersey Life and Health agent, and have them make an introduction. That way we can make sure that you have that center of influence, that sphere of influence that we talked about together, and that we can all discuss exactly what's going on in your situation, especially if you have questions about, can I afford this healthcare? What do I want to do? That's where we really come in and work together.
Yeah, it's been very cool when we're able to be on the call with you while you do that free financial plan and initial consultation, because, we're able to build in the healthcare costs with what you guys are doing. So it gives you a better idea. Sometimes even the most educated Medicare person might not know every penny, every nickel, all that. So we're able to create a holistic view. And to anybody watching on YouTube, anybody listening on Spotify or any podcasting service, I will link the email address, their website, all their social media, in the description of whatever's happening. So if you want to reach out to Nick, some of his great teammates, please do, because they are fantastic, and we're happy to help you out. But Nick, you have been so awesome. Like I said earlier, I don't think we could have gotten a better first guest to really bring in this podcast and talk about all the great things and create a holistic retirement plan for people. So thank you so much, and I hope to have you on again sometime soon.
Ken, thanks so much for having me. It was my pleasure.
Thanks again for tuning in to Talking Retirement on YouTube. Please like and subscribe to keep up with the podcast, and check out all the other great educational content we have on the NJ Life and Health YouTube channel. If you'd like to listen to an audio version of the podcast, you can find us on Spotify, Apple Podcasts, and pretty much all other major podcasting platforms. For daily senior tips and to keep up with us at NJ Life and Health, follow us on all major social media platforms such as Instagram, Facebook, and TikTok at NJ Life and Health. And of course, if you'd like someone in your corner to help you with Medicare and life insurance, we would love to talk to you. Visit our website at www.njlifeandhealth.com or call our office in Toms River, New Jersey at 848-226-6897. We'd love to set you up with an appointment with one of our Medicare and life insurance brokers, and we are licensed in a lot of other states besides New Jersey. So no matter where you are, there's a chance we can help you out. Anyway, hope you enjoyed this podcast, and we will see you in the next episode.